Welcome back to our discussion of Chapter 6. So in our first video, we looked at some of the basics of Chapter 6, some new concepts, some new terms, and the bulk of it really was looking at the periodic inventory system versus the perpetual inventory system. So we compared both of those in our first video. Now in the second video, we're going to finish off this chapter and look at some other important concepts as well. So we're going to one of the things we're going to look at is credit terms and discounts. So manufacturers and wholesalers, they usually sell their products on account. So remember, that means if you sell something on account, you don't sell it for cash. Instead, there's the promise of payment at a later date, right? So if we buy something from a supplier on account, we get to pay them later instead of paying them right away. So usually manufacturers and wholesalers, they'll allow their customers about 30 to 60 days to pay on average. It depends obviously on the specific manufacturer or wholesaler, but usually it's 30 to 60 days to pay. And often, because these things are sold on account, often sellers will offer customers a discount if they pay within a specific period of time to encourage their customers to pay early. Because remember, these suppliers, they'd rather get $1 early than wait for that $1 later on, because theoretically, $1 today is better than $1 tomorrow, because I can take that $1 today and invest it for a return. So really that's the concept behind that. Earlier payment is always better, because it's always better. It helps with keeping your cash flow strong, right? So any company would rather take cash early as opposed to cash later. So to encourage customers to pay them early, a lot of companies will, or suppliers, or whatever, if you want to call it a manufacturer or wholesaler, but we can refer to them just as suppliers in general, will often offer their customers discounts. And these discounts, or when these sales are made, there's credit terms attached to them when you buy something on account. So a common term that is offered, they vary greatly, but a common term that will be offered is 210 net 30. So if I'm a company buying from my supplier, this might be a common credit term. If I'm paying for, or if I'm buying something on account, this might be a common credit term. 210 net 30 that they attach to that agreement. So what does this mean? So this 210 net 30, that's how it reads. It could have been 410 net 30 or 415 net 45, whatever they end up doing. But this is how you read this and what this means. The 30 means that full payment is due in 30 days. That's what that means. The net amount is due in 30 days. However, the way this is set up, this means you can get a 2% discount if the full amount, or in this case, the discounted amount, or whatever the agreed upon amount is, if paid within 10 days. So this means that if I buy something on account for my supplier, and these are the terms, they're offering to give me a 2% discount if I pay them within 10 days. However, if I don't pay them within 10 days, I have to pay the full amount in 30. So that's how you would read that. So if you are the buyer, this would be the terms of your discount. However, if you're the seller in this situation, if you are the supplier, this would be the sales discount that you're offering to your customer. So this is really common practice. However, how you decide to record your purchases of inventory or your sales, if you're the one selling, whichever perspective we're taking it from, there's two ways that you can record these transactions. You can use the net cost method or the gross method. Now, it's really often argued that well-managed companies, they will record purchases at net cost, or using the net method at net cost. So the net cost really all that means, that's the full invoice price less the discount. So including that discount. So if a well-managed company will record their purchase at net cost, because the net cost is what they expect to pay. They expect to pay within that discount period. Because really, if you look at some of these larger companies, 2% might not seem like a lot. But especially the larger you are, 2% of millions, that can be substantial. And really for any company, any money that they can save, the better, right? Any cash I can save, that's a good thing. So well-managed companies, that's why well-managed companies will use the net cost method, because these transactions, these purchases are recorded in expectation of paying within the discount period and in expectation of actually being able to take that discount and save that money. So with that in mind, let's take a look at what it would look like for recording purchases at net cost. Let's see what that would look like, and I'll put a problem in here. All right, so let's take a look at this problem here. It says on November 3rd, Computer City purchases 100 programs for $100 each from PC Products. Credit terms 210 net 30. Assume they use a perpetual system. Okay, well, if they purchase 100 programs at $100 each, that comes out to $10,000 total purchases. So under the net cost method, remember we record the purchase assuming we will pay in time to get the discount. So how much would the discount be? It's 2%. So if the discount, a 2% discount means you pay how much? That actually means you pay 98%, right, of the full amount. So that's one way that you can figure out the math for this. I use the 98%. So this is how I look at it. Of the 10,000, that's the total invoice price. If we're recording this at net cost, we're assuming we're going to pay in time to get the discount. So that means we only expect to pay 98% of that 10,000. That is $9,800. That's the net of the discount. So the $9,800 is what I actually expect to pay. Or you can take 10,000, multiply by 2% to get $200 of a discount and subtract that from the 10,000. So how do I then record the purchase? Under the net method. Remember, you record it assuming you're going to take the discount. So under the perpetual system, we use the inventory account. So we're going to debit inventory because I just bought some more inventory. But I'm not going to debit it for 10,000. I'm going to debit it for 9,800 under this method. Right, assuming I'm going to take that discount, and I'm going to credit accounts payable because I bought it on account, right? There wouldn't be credit terms unless you bought it on account. And I'm going to credit accounts payable for $9,800. So that's what it looks like when you record a purchase under the net method, assuming you're going to be able to take that discount, and especially under the use of a perpetual system. If this was a periodic system, the only difference would be I would be debiting purchases instead. Now let's take this a step further. So now we've recorded the purchase of the inventory, but now let's assume it's a month later and Computer City waited until December 3rd to actually pay, right? They took the full 30 days. Since they waited longer than the 10 days to actually pay the $9,800, or really the $10,000, they're going to lose the discount. So they're not going to get the special price of $9,800. They're actually going to have to pay the full $10,000 since they waited longer than 10 days to pay. So because they waited longer than 10 days because of the credit terms, they lose the discount, which is $200. So they're not going to pay $9,800, but the full $10,000. So with this kind of entry, you kind of build it because these entries are going to look a little bit different because we have something added in. So the question is, how much cash do we have to pay? In this situation, the cash that you need to pay, we know is $10,000. But how much did you record your accounts payable for? Record the accounts payable for $9,800. Those don't match up. So where is that $200 where's that going to go? Because we can't change the accounts payable. It's already on the books for $9,800. Well, we said we lost the discount in this case, right? Because we thought we would take it. We anticipated we'll take it, but we lost the discount. So there's this new account that we're learning about now called purchase discounts lost that needs to have $200 added to it. So your cash is going down by 10. Your accounts payable is going down by $9,800. And you have your purchase discounts lost, which will balance that entry out. Let's take a look at what that would look like. So accounts payable, since you're paying finally what you owe them, we have to remove that payable off of the books with a debit. So we will debit accounts payable for $9,800. You will debit purchase discounts lost for $200, and you will end up crediting cash for $10,000. So when we record purchases at the net cost method, you anticipate you'll take a discount, but when you miss the discount, you actually have to record the amount of discount that you ended up losing out on. This is why we say well-managed companies do it this way, because this way managers can look at this accounts and keep track specifically of how much discounts they're not taking. Because if constantly this account grows and grows and grows, and the amount of discounts that aren't being taken grows, that will indicate that something needs to be done to get them back on track so they're taking as many discounts as they possibly can. So that's what the entry would look like on the day that you pay them, but if it's outside of that discount period. But what would it look like within the discount period? What if Computer City paid PC products on November 13th? Well, when did we make the purchase? The purchase was made on November 3rd. November 13th, that's 10 days after the purchase, so that's within the discount period. So if we made it within the discount period, well, the accounts payable that you recorded initially, that was $9,800. Well, if you made it within the discount period, how much cash are you going to have to pay? Well, then you get the discount. Then you only have to pay $9,800. So if you actually make it within the discount period and you use the net method to record your purchases, you will debit accounts payable for $9,800, like we did above. But since you don't lose out on a purchase discount, you actually get to take the discount. You'll credit cash only for $9,800 in that situation, if you end up paying in time to meet that discount. Okay, so that was the net method for recording purchases. So recording purchases at net cost. But what if you are a company that doesn't opt to do it that way? Then the other method is recording purchases at gross invoice price. So that's the alternate method that we have here. All right, so with the gross invoice price method, or just the gross method, you record the purchase of inventory assuming that the discount won't be taken. Although you might, it's just the way the recording is done, you're really assuming you won't take the discount. Okay? So let's look at an example problem. All right, so again, we're looking at Computer City. So let's assume on November 3rd, Computer City still made a purchase of $10,000 of merchandise on credit with terms 210 net 30, but using the gross invoice price method. And still assuming the use of a perpetual system. So again, we are making a purchase of $10,000 of merchandise on November 3rd, terms 210 net 30, but here we use the gross invoice method. So under this method, you assume you won't take the discount. So what does this look like? So here, we'll debit inventory, and let's do that with brighter pen here. So we'll debit inventory for $10,000, and you will credit accounts payable for $10,000. So here you're recording that payable as if you pay the full 10. So how does this differ from that first entry we did? Where that first entry, we debited inventory under the net method for the net price, the price minus the discount. But under the gross method, you debit inventory for the full purchase price, the full $10,000. Okay, so that's the main difference for recording that initial purchase. So let's take a look at now when it comes to actual payment. All right, so let's assume November 10th rolls around and Computer City decides to pay the full amount due to PC Products. Well, if it's on November 10th, that's only 7 days after the initial purchase, so they're well within that discount period. So they're actually going to end up getting a 2% discount if they decide to pay this early, even though they recorded the purchase, assuming they won't take the discount. So the $10,000, they're only, if they get a 2% discount because they're paying early enough, they're only going to have to pay 98% of that, which is $9,800. So that's the discounted price. So what would the entry look like then? How in the world do we deal with that? Well, since we're paying them what we owe them, we're going to still remove the accounts payable like we did before. So you're going to, since you're paying off a payable, you'll debit the accounts payable for what we recorded it as initially, which was the $10,000. So we debit accounts payable for $10,000. And the question is, if your accounts payable is $10,000, but you're getting a discount, how much cash are we paying? We're only paying $9,800, right? So that's what we know so far. So let's build the entry with what we know. So I'm only going to end up crediting cash for $9,800. Well, how do I make that balance? It's going to have to be a credit for $200. And what do I credit for $200? Another account that you haven't heard of before called Purchase Discounts Taken. Because under the gross invoice price, we assume we aren't going to take a discount, but when you actually do make it in time to get a discount, you have to record that discount because now the accounts payable doesn't match up with the cash you're paying. So to make that entry balance, we put that balancing amount into the account called Purchase Discounts Taken. So that's what that would look like if you pay early under the gross method. However, what if you pay late? What if paid in full on December 3rd? What then? Well, what if you anticipate you were going to pay $10,000? Well, if you wait a month to pay, how much are you going to pay? $10,000. And how much did you record the payable as? $10,000. So on this day, if you use the gross method to record purchases and you wait too long and you're actually not going to get a discount, then you'll debit accounts payable for the full amount still. You'll debit accounts payable for 10, and you'll credit cash for a full 10. Because if you don't make it in time for the discount, you'll pay the full $10,000 there. All right, so that is the comparing net method to the gross method when we're recording purchases. All right, now what about when inventory is returned? What about returns of merchandise? Well, if merchandise is returned, you basically treat it as the opposite entry. The entry will look the opposite of what it looked like when you actually purchased the merchandise. So it's the opposite of the entry to record your initial purchase. So what you will do is you will decrease accounts payable with a debit, and you will decrease inventory with a credit. So whatever the amount is, you'll debit accounts payable, because if you return some merchandise, you're going to owe them less, right? So we have to decrease the accounts payable for how much merchandise you returned. And since I returned it, it's no longer in my inventory, so I have to credit inventory for how much I ended up returning. So that's what the entry would look like if you're actually having to return merchandise. What about transportation costs? The transportation costs involved with acquiring your merchandise. What about those? Shipping costs, right? Getting my merchandise to where I need it to be so I can sell it. So the transportation costs that are related to acquiring your inventory, you do not include them as expenses of the current period. They are not expenses of the current period. Instead, these transportation costs, they become part of the cost of the asset acquired or the merchandise acquired. So really, this doesn't even just refer to if you're buying merchandise. Also, if you're buying, let's say, a new truck for the business, any shipping costs that you have to pay to get that truck to your place of business, that's added into the overall cost of the asset before you put it on the books. So any transportation costs, you don't list them as expenses of the current period. Instead, they are included as part of the asset's total cost. So if we're looking at the total cost of merchandise, it's not just the cost per unit. For example, you'll also factor in what did it cost to get the merchandise to me, and that will become part of the total cost that will go on the balance sheet. All right, net sales. Net sales. This refers to sales revenue minus any sales returns and allowances and minus any sales discounts. Because a part of business, doing business, especially if you're a retailer or a merchandiser, is people are going to at some point return some things, or you're going to give a store credit to someone, or you're going to give them discounts. All of those things eat away at your revenue. So we calculate net sales. Net sales is just your sales revenue minus those sales returns and allowances and minus those sales discounts. So we're going to look at sales returns and allowances here as our next topic of conversation. So sales returns and allowances. And again, a natural part of doing business. So a lot of companies allow returns and give store credit. All right, so to illustrate sales returns and allowances, let's look at this example. So on November 5th, Highlander Pub returned $1,000 of unsatisfactory merchandise to Computer City. Remember the company we've been working from, the perspective from. So this pub returned $1,000 of unsatisfactory merchandise to Computer City from a November 3rd sale. Computer City's cost for the merchandise was $600. So basically, this company returned $1,000 worth of merchandise to Computer City, and the merchandise that was returned to Computer City cost Computer City $600 to acquire in the first place. So that's what we're looking at. So because Computer City uses a perpetual inventory system, we're assuming the use of a perpetual inventory system, unless otherwise noted, they must make 2 entries. So because a perpetual inventory system is being used, 2 entries need to be made. Because why? Well, when we make a sale, remember under a perpetual system you make 2 entries. You record the sale and then you record the cost of the sale. Here we're going to reverse both of those partially. So a sales return, which is what's happening here, a sales return, it reverses recorded revenue because that's what's happening, right? If someone's returning merchandise and getting a refund for that, you're reversing whatever revenue you recorded initially. So we don't outright decrease sales. We're not going to go in and alter the sales account itself. Instead, we're going to use a contra revenue account called sales returns and allowances. So instead of debiting sales, remember to reverse that revenue, instead of debiting sales, we're going to debit an account called sales returns and allowances. a contra revenue account. So we're going to debit sales returns and allowances for the $1,000 of merchandise they returned. And we are going to credit accounts receivable or cash, either because if they still owe us for the total amount that they bought, we can just reduce the receivable, reduce what they owe us, or we can just credit cash if they're getting an outright cash refund. So that's the first entry to record the sales return. But remember, they're giving us inventory back. So since the revenue is reversed, we also have to record inventory being returned. And remember, when we record the cost of a sale, you increase cost of goods sold and you decrease inventory. So we want to reverse that. So since they're giving us our inventory or part of our inventory back, we're going to debit inventory for $600 because remember, what did the inventory cost us that we sold them at $600? So we're going to debit inventory for $600 and we're going to credit cost of goods sold by $600 as well. And again, why are we doing this? Because first of all, you had to reverse the revenue, and also now you're putting the inventory back, and since this inventory that you're getting back is no longer goods that are sold, they were returned, we have to reduce cost of goods sold because it actually ended up coming back to us. So when you record a sales return, you don't decrease sales outright. You use the contra asset account called sales returns and allowances, and you also need to make sure in a second entry to put it back into inventory and reduce your cost of goods sold. Now, what about sales discounts? Sales returns and allowances is the first item we looked at. It's a contra revenue account. Another contra revenue account is sales discounts. So this is when we're not necessarily talking about returns, but we're actually giving our customers a discount on the sale. So let's take a look at an example here. All right, so on November 10th, Computer City receives the full amount due from Highlander Pub from the November 3rd sale, less the November 5th return. So we're assuming that now we're factoring in that return of $1,000. And let's assume the full amount that they have to pay us is $1,000. So let's see what the initial recording of that sale would have looked like. Let's do initial sale on November 3rd. And since the initial sale itself would have been for $2,000 if they're having to pay us $1,000 since they returned $1,000. So let's just assume that the initial sale, if we're not even thinking of a return, if we're just looking at what they would have owed us, because I don't want to overcomplicate this because they didn't start off with the full details with this example. So let's assume when we initially recorded the sale, it was a debit to accounts receivable and a credit to sales. So let's assume they owe us $1,000. Let's ignore the sales return actually for this purpose. But now on November 10th, they are paying us what they owe us. But let's assume the credit terms we extended to our customer was 210 net 30. So let's assume there's credit terms extended here. So the full amount that they have to pay us is $1,000, but we have to remember we extended credit terms to them. So the initial sale was on the sale that we made to them was on November 3rd, but now on November 10th, they're deciding to pay us. So from the 3rd to the 10th, that's only 7 days. That's within the 10-day discount period. So what's going to end up happening here actually? This is early enough for them to get a 2% discount. So they're actually going to get a 2% discount from us. So now we're doing it from the perspective of the seller. So 2% discount, what would that look like? $1,000 times 98%. That means they're only going to have to end up paying $980 because 2% of $1,000 is $20. So $20 off of $1,000 leaves me with $980 that needs to be paid. So in this case, how much cash do they actually have to pay us if these are their credit terms and they're actually paying us within 10 days? The actual cash they actually have to end up paying us is $980. But how much did we record their accounts receivable as? $1,000. So we can see here that the discount that they will end up getting is $20 discount. So how would we record that on the books? What would that end up looking like? Well, how much cash are we getting? $980. So let's debit cash for $980. Accounts receivable, they're paying us off, right? So we actually have to credit accounts receivable for the full $1,000 because now they're paying us what they owe us. But for this to balance, there needs to be a $20 debit. And that $20 debit, that's going to be a debit to an account called sales discounts, our other contra revenue account. So this account will indirectly decrease sales to give us the net sales amount, but we're not actually going in and altering the actual sales account. So that's what this would look like if you had to record a sales discount if a customer pays within the discount period. If they didn't meet the discount, you'd have just debited cash for $1,000 and credited accounts receivable for $1,000. So just as a reminder, sales discounts and allowances, they're contra revenue accounts. Sales discounts and allowances, they reduce your gross sales, your overall sales amount. So net income, it's going to be incorrect if your discounts and allowances aren't properly recorded. So that's why we make sure to record these things very accurately, like we saw how to do now with sales discounts and then previously with your sales returns and allowances. All right. What about delivery expenses? So how is this different from transportation costs? Transportation costs are those costs that we incur to get the merchandise that we purchase to us. Delivery expenses, this involves any cost that a seller incurs to deliver merchandise to a customer. So costs incurred to deliver to a customer. So we're switching the perspective here. You're not the one buying the merchandise, but if you're now the one selling something. So if a seller incurs any costs that to deliver merchandise to a customer, how are we going to treat delivery expenses? So these costs, they are debited to an expense account titled delivery expense. So this is considered an operating cost, an operating expense. So it is not, because it's not part of the cost of the goods we sell. So it's not going to be considered part of cost of goods sold. It's just an operating expense. And why do we do it this way? The answer is this is just what they've decided on for the rules for treatment of delivery expenses under US GAAP. So it would make sense in a way to include it as part of the cost of goods sold. But since this is not involved, because remember, cost of goods sold is the cost of the goods we sold. So the overall cost of obtaining that merchandise, once you sell it, it goes into cost of goods sold. A delivery expense happens after the fact, right? Once you sell it, to the cost you incur to get that product to the customer. That could be one of the reasons why it's considered to be external from cost of goods sold and considered to be its own expense, delivery expense, not part of cost of goods sold. It's considered an operating expense nonetheless, but it has its own account. So just keep in mind, that's how we deal with delivery expenses. And then what about sales tax? How do we account for sales tax? What does that look like? And let's fix that there. So sales tax, it's also part of life, especially if you live in California, right? So sales tax is a thing. So businesses, they will collect sales tax at the point of sale. We all know this, right? If you go to Target and something is $19.99 off the shelf and you go and they ring it up at the register, it's going to be more than $19.99. Why? Because of sales tax. So a business, when they make a sale, they will collect sales tax when they make that sale. Then they hold on to that sales tax collected, and they will remit that tax to the appropriate governmental agency. IRS in most cases at the times specified by law. So every state law will be different. There are other states that also charge sales tax, but then the company will hold on to the sales tax and then remit that to the proper governmental authority. So what would that look like? How do we account for that actually? So let's take a look. Let's record sales tax on a $1,000 sale with a 7% sales tax. So what would that look like? How are we going to account for that on the books? Well, if you're making a sale of $1,000, then the customer has to pay 7% of that $1,000 in taxes. 7% of $1,000, that's $70 just in sales tax. Do you get to keep the $70? No. You're just going to take that from the customer on behalf of the customer and then pay that to the government on behalf of the customer. So what is the amount of cash that the customer will end up paying you on that day when you make that sale? They're not just going to pay you the $1,000 that they owe you, but they also are going to pay you $70 in sales tax. So the total amount of cash that you receive is $1,070. So how much of a sale did you actually make? How much of that $1,070 is actually a sale? $1,000. Okay, well, the $1,070 doesn't quite balance out with $1,000. Well, that's because the other part of that is sales tax payable. How much of a sales tax is there payable to the government? $70. So again, you're getting $70 more than the actual sale. So you're actually holding on to that cash, but that $70 is not yours, right? That $70 actually represents a liability, the sales tax payable, that actually needs to go to the government. So how would we record that sale? So you're going to, oops, that's still highlighter. So you are going to debit cash or accounts receivable, depending on how the sale was made, if it was in cash or on account. You're going to debit cash or accounts receivable for $1,070, because that's how much cash you'd be receiving or how much cash they'll end up paying you at a later date. Then you are going to credit the liability account called sales tax payable for $70. And you're going to credit your sales account, your revenue account, for $1,000. So that's how a company will account for any sales tax. So that's the accounting treatment for that. And then just one last comment to make. I'll show you guys how to calculate gross margin percentage, or really gross profit margin. So you calculate this by taking your gross profit or your gross margin and dividing that by your net sales. So both of these need to be calculated. So the gross margin percentage, your gross profit, remember that's your sales, or really your net sales, minus your cost of goods sold. And your net sales, that's your sales, minus your sales returns and allowances, and minus your sales discounts. So the gross margin percentage, really all that says is what percentage of my net sales is my gross profit. So really what percentage of my net sales is not consumed by cost of goods sold. So the larger your gross profit percentage, the less amount of your net sales is consumed by your cost of goods sold. So that's what we're going to end off with for this chapter. Good luck with the rest of chapter 6.